Welcome back to the What's Your More podcast. I'm your host, Quinton Harris. You're dialed in for the next episode of What's Your One More, and I've got with me this week another outstanding guest. He's kind of become a pseudo stand-in guest once a month, and I'm so happy he's decided to do that. Welcome back, Mr. Dan Habib, to the show.
Hey, Quinton. Always a pleasure to be with you on the podcast, man. Thank you so much for having me.
Same here, man. Glad to have you, all the knowledge you bring to our audience. And, you know, this is kind of a different week since you've been here before because it's post-Fed decision week. We've got a lot to talk about. We kind of been waiting on getting this episode in here. And I just want to kick it off. I mean, you know, I think the obvious is we had a Fed rate cut. And they came with a little bit of deflating, moment for some people in the industry and consumers as well, because we hear rate cut, we automatically assume like, where's those lower mortgage rates? And, I think you're here to kind of enlighten us on it's not just a cut. There's other things that could affect long-term rates, but that maybe there's some hope in the future for those things to get to where we're hoping they are. But why don't you kind of break it down for us here, that cut and the impact to the mortgage interest rates and maybe why we haven't seen that fall off that everybody wanted to see.
Yeah, well, I completely see why people are saying out there, and seeing that it looks like, at least if you're looking from the time of the cut till when we're recording, hey, the Fed cut rates and mortgage rates have moved a bit higher. But I do think that that's a little bit of a myopic view, and I'll really break this down for you. But first things first, listen, some listeners may not be aware. When the Fed is cutting rates or hiking rates, they're not cutting long-term rates. They're not cutting the 10-year or mortgage rates. They're cutting the Fed funds rate, which is an overnight rate that banks use to lend to one another. But there's certainly indirect influences to longer-term rates, like mortgage rates. Now, getting back to what people are seeing out there, if you just look from when the Fed cut on September 17th till now, mortgage rates have moved a little bit higher, but you have to contemplate more than that. So markets are forward-looking, which means that when they price in that something's going to happen, they move in advance of it. So you have to not just look at what happened after the cut. You also have to look what happened before the cut. And on August 22nd, we had Fed Chair Powell at Jackson Hole, Wyoming, and that's where he first really telegraphed that the Fed was going to cut rates. On that day, 10-year was at 4.33, and you had mortgage rates 0.3% higher than where they were on the day that the Fed cut rates. So the 10-year, by the way, came down to about 4.03, actually dipped for a little bit under 4% on September 17th when they cut. So what happened? The markets priced in the cut, and even long-term yields, they moved down by more than 25 basis points. Then the day of the cut, what happens? Well, they moved slightly higher that day. Powell, you could say, and we can get into the press conference and his meeting, was maybe a little bit more hawkish than some people would have liked. And we can go into the dots plots too, which will be, I think, interesting. But just sticking on this theme, the day after the Fed rate cut, we got some news that bonds didn't like. And the other thing, besides looking before what happens with rates before the cut and just looking at the price movement after, you have to ask, is there any coincident economic reports that are coming out that are pressuring the bond market and pushing rates higher? And of course, how is the rate cut being interpreted by the markets? If it's interpreted as something that's inflationary, well, the bond market could also not like that. Now, I don't think it's the latter there, but if we look at the coincident economic reports that came out, well, let's take a look at Thursday, the day after the Fed cut rates, September 18th, we got a very low initial jobless claims number. Now, the prior week, before the Fed cut, we had 264,000 initial jobless claims. That's people filing for unemployment benefits for the first time because they were let go. It came down to 231,000. So lower than estimates. And even though this isn't showing job creations, it's certainly showing you a part of the labor market. And let's face it, the Fed cut rates because of a weakening labor market. So while not fully negating that, partially, this is kind of going contrary to the Fed's reasoning for cutting rates because you saw claims fall. And then the day of recording here on the 25th, boy, we had a trifecta of stronger economic reports that came out that also soured the bond market and caused yields to move higher. You had initial jobless claims falling further to 218,000. You had GDP that was revised higher in the second quarter from 3.3% to 3.8%. And you had a very strong durable goods orders report, all of those causing rates to move higher. But when you look at this in totality, long-term rates usually respond well to Fed rate cuts, but sometimes there's factors, and we saw this last year. You can have stronger economic data points that can cause the market to move higher. But what we have seen this year and last year is once the markets found out the Fed was going to cut and they telegraphed it, long-term rates move lower. And I think it's helpful, Quinton, to just share a little bit of a chart here, just so everybody can visualize this, because last year people were saying the same thing. Last year people said, well, the Fed, they cut rates, but, let's pull up the right slide here, but rates moved higher. And if you remember to 2024 and September 18th, they cut 50 basis points. Well, that's right here on the chart. But what nobody talks about is the 3 to 4 weeks prior, when the markets found out that the Fed was going to do this cut, mortgage rates moved down between 5/8 and 0.75%. Then you could see the Fed cut rates, 50 basis points right here. What did mortgage rates do? For 2 weeks, they remained stable. But then right here on October 4th, something important happened that caused mortgage rates to move higher. Well, we got a blockbuster jobs number. You could see here we got the September jobs report released October 4th of 2024, much stronger than estimates. 254,000 jobs created. And going back here, we got the November cut. Guess what? We had the same thing happen. We got the December cut. December cut here, same thing happened. Blockbuster jobs numbers. Now, it's frustrating because we do know that the Fed, or I should say, we do know that the BLS, they came out with their QCEW numbers, and it showed that likely 52% of these jobs, they don't give you the individual months at this point, but they overstated job growth by 911,000 last year, or they overstated job growth by 52%. So these numbers that really roiled the bond market, and I think is one of the main reasons we saw yields move higher after the Fed cut, were baloney. And this is a long-term chart and correlation that I think best shows you that while it's not in lockstep and while the Fed's not cutting short-term rates, there is a very good correlation over time of the Fed funds rate, which is in blue, and 30-year fixed mortgage rates, which is in green. And you could see how the Fed hikes, mortgage rates go up, the Fed cuts, mortgage rates go down. Again, it's not perfect, it's not in lockstep, but there is certainly a relationship there. But we can't just look at the market movements after the Fed cuts and not talk about how they reacted in advance of the cut and pricing that in. And also if there's coincident economic reports that are showing all kinds of strength in the economy that would cause the bond market to sell off anyway. So I wanted to just kind of break that down step by step, Quinton, and tell me if you have any follow-up questions on that before we go any further. But one more thing, this is a chart of the 10-year. You can see this is Jackson Hole meeting, August 22nd. Look at how much yields moved down in anticipation of the rate cut.
Yeah, I think that's a wonderful explanation. I think there's consumers and mortgage lenders and real estate agents have to understand the market predicts or moves as with the way they think the Federal Reserve is going to react. And they're always trying to anticipate that. So when it does exactly what they're anticipating, there's not this windfall of additional, wins for us in the industry. And the availability of information now is far greater than it was even a decade ago. So we have a lot more opportunity to understand and forecast, as you say, forward think what's going to happen. So when we get what we're anticipating, it's almost like a stagnant when nothing really goes up or goes down. But then these job reports come in.
Thing, Quinn, in the markets, right? And it's buy the rumor, sell the news, right? Which means that once it's, kind of made public that something's going to happen on a certain date, the markets look forward and they react in advance of that. And a lot of times on the day of the news, right, you see a sell-off where people take profits and stuff. So it doesn't always work in the way that people think.
Yeah, no, that's a great point. I think that the podium pal, as I like to call him, when he gets up there, unfortunately, has that way of shifting the markets. And when he gets up there and, like you said, slight more hawkish than what people were anticipating, that's gonna curb the market. And we got to that 3.95 on the 10-year, and I think we were all really excited in the industry about that. The mortgage-backed securities market was moving in the right way. We were seeing some, instant relief, if you may, and then it was just evaporated immediately right after that 30-minute podium session.
Well, rates are still, I don't think it fully evaporated. I mean, rates moved a little bit higher the day of the Fed meeting, but minusculely. But then, in the time since then, we've seen yields kind of drift higher, but they're still a bit lower than where they were. But everybody wants to obviously these rates come down again, right? To the low sixes, 6 1/8, to 6 1/4. Now, I think those that were prepared and set up strike rates with their customers and weren't reactionary definitely capitalized on this drop a bit. But sometimes it can be short lived. But listen, it doesn't mean that rates can't cycle back lower again. It means that the upcoming jobs report, which is going to be on October 4th, is really going to be critical. And listen, the last jobs report was important, but I can't remember a more important jobs report with more future implications on the path of the Fed funds rate, as well as the direction of mortgage rates, than this one coming up, because it's going to, if it's a strong report, which, listen, I don't anticipate it to be, but if for some reason the BLS, who we know hasn't been reliable, if they come out with a strong print, it could take off any further rate cuts this year. But if it's a weak report, I think it certainly solidifies at least one more cut, but potentially two. But the upcoming data is going to be critical. And then, of course, we have at the time of recording here, a big PCE report that's going to be coming out tomorrow morning. And that's something that the market's expecting the headline to go from 2.6%. This is headline PCE, personal consumptions expenditures, to either 2.7 or 2.8. I see estimates kind of in that range. And then the core reading is expected to stay at 2.9%. Yeah, I'm not sure how much propensity there is for a surprise to the downside. There's probably, I think, the risks favoring propensity for it to be the upside. But, if it comes in around estimates, it still wouldn't look great optically for headline inflation to rise a bit. But I don't think we're going to be hurt too bad if we get a number near estimates. Listen, the Fed has said that they're anticipating inflation to be, in the short term, moving a bit higher due to the temporary impact of tariffs. And that's something that's certainly been a little bit of a shift, where now you hear Powell and a lot of other Fed members saying that they're more comfortable with thinking the tariff impact is going to be short-lived, but that it may not be all at once, right? I mean, we have still some big trade deals out there that have not been closed with China, India. So once you have that set, the price goes up, whatever the tariff is, and then that is one time, but the impacts can be felt over a duration.
Yeah, and I think it's real important for our audience members to understand that rates are still low in comparison to where we were a year ago, 18 months ago. I know we're all, as you mentioned, aiming and shooting for the low sixes, and in some cases we're there. We're still there as we have this conversation right now. And on government loans, we're below that. But I think that everyone's like, it's interesting when you talk about strike rate. You call a customer and they're oh, this is my strike rate, and then you call them with this wonderful opportunity. We're there. And some of them have the audacity to go, I think I'm going to wait. And you're like, okay, your choice, frustrating as it may be.
I would show them, and we have so many charts like this in MBS Highway that you could share, but I would show them the short-lived nature of the opportunity, right? And there's been marrying the home and dating the rate over the last few years has been a great strategy if you had a good loan officer that was prepared, because there's been 8 refinance opportunities, but many of them have been extremely short-lived. Some of them a day, some of them a week, some of them 2 weeks.
Thank you.
But the opportunity has been there, and you've seen some good levels of appreciation as well. And there was certainly an opportunity here. But if customers get greedy, we also have a great calculator that shows you, hey, listen, what are you waiting for? An extra eighth? So an extra eighth's going to save you, I don't know, $25 a month, whatever it is, depending on the loan amount, right? And if it takes 3 months to get there and you gave up the guaranteed savings we could have given you, it's going to take you 2 years to break even to save that extra $25 a month, right? So you need to explain to the customer and maybe use some tools and show them some figures, because they're not thinking that way. That if it takes 3 months to get there, even if you're right, it's going to take 2 years to break even. And look at these short opportunities in the past. You might miss the opportunity, right? But we could save you $250 a month or $300 a month right now.
Yeah. And that's a great point. Those cost of savings tools you have, the cost of waiting tool, all those things we use in our day-to-day to explain that exact same situation right there. But just to reemphasize, like for agents listening, loan officers, consumers, guys, it is low as it's low as we've seen in quite some time. So this ideology of we didn't win, or I wish they'd have been lower, they are low right now. And it's something that I'm excited about, which brings me to the next question. Dan, where does the Fed go from here? I mean, we know we got a jobs report. It's the blockbuster report, October 4th, nothing bigger than this report. It's going to set up or let down the next Fed, open market committee meeting. But where do they go from here? Is it all hindering around jobs, or is it labor over inflation, as we've heard people say? Like, what is it at this point?
Yeah. Well, first, let's just look at this September 17th meeting. This is one of those meetings where the Fed releases what's called their SEP, or their summary of economic projections. And part of that is the dots plot chart. So there's 19 Fed members, 12 of them vote, but all 19, they anonymously put a dot on this plot here. And it shows where they think the Fed funds rate should be this year, next year, and so on. So for this year, one thing you can see that I can't remember seeing a greater version of division is how divided the Fed is. So you have one Fed member, and I could take a couple guesses on who this would be, maybe Schmidt or Cook, but they actually are putting that they want the Fed funds rate 0.25% higher than where it is after they cut. Now, I don't think they actually want to hike, but this is their way of still voting in line with the Fed chair, but showing their dismay for the cut at the meeting. But then you have 6 Fed members that want no more cuts this year. You have 2 that want 1 cut, and then you have 9 that want 2 more cuts, and then you have 1 that wants 125 basis points of cuts, and we know that's Stephen Moran.
We know who that is. We like that person.
No, he obviously is the outlier there, but the median, is 2 more cuts this year. Now there's 2 more meetings this year, October 29th, December 10th. The markets are still pricing in, at least a cut at one of the meetings. I haven't looked recently at the percentages to see if 2 are still being priced in. But to your question, everything is going to rely on what happens with the jobs data, in my opinion, because the inflation data, I don't anticipate to see it go crazy. And there is a little tolerance there for the inflation data to move a little bit higher, because the Fed is anticipating some higher reads temporarily due to inflation. But the whole reason why the Fed went from pausing for several meetings to cutting is because they have a dual mandate. They've been focusing more on inflation, but now the risks to the labor side of their mandate, maximum employment, have really kind of gotten a little more out of whack and more concerning. So, you have to remember, the BLS was reporting really strong numbers, and now the average job growth over the previous 3 reports is only 29,000 a month. June was negative 13,000. August was 22,000. The unemployment rate has been edging up a little bit. And something that you hear the Fed members say all the time is how the break-evens have moved down. So what are they talking about? Well, the break-even jobs is essentially how many jobs need to be created to keep the unemployment rate stable. And what they're saying is with all of the immigration changes, the supply of labor has come down. But at the same time, there's no hiring happening either. But theoretically, if they both fall in unison, the unemployment rate remains the same. But you can't ignore the fact that there's no demand for labor and no hiring going on. Because if all of a sudden you start to see an uptick in layoffs, the unemployment rate can go up, and it can go up quickly. And just look at this chart. This is why it's so important to follow the unemployment rate, because this goes back to like 1945. And the blue line's the unemployment rate. These vertical lines are recessions. You could see in most cases, when you bottom out on the unemployment rate and it starts to turn higher, it happens quickly, and a recession usually occurs as well. Now, this time, and this is what we would call usually like a V bottom, right? You could see it kind of looks like a V, and some of these could be a little bit more W-ish, right? But this is a little bit interesting, and it's a little different, where you could see, unlike in these other market cycles, the unemployment rate, it hasn't yet, at least, made that huge move higher. It's just been kind of slowly eking higher. Now, does that mean this time is different? It could. But it also could mean that we could have a sharp rise like this coming, which is why, listen, it's important to really make sure you're getting ahead of labor market weakness, because things can turn very quickly. And the reason why the Fed has the ability to cut, and I think cut more, is because they're restrictive. So I think this is an important concept. It may be a little technical, okay? But you hear some Fed members saying the Fed is close to neutral. Some saying like we have room to cut a few more times before getting to neutral. Some like Stephen Moran, who says we could cut a ton before getting to neutral. So what does that mean? So the Fed funds rate, it could be one of three things. It could be accommodative, which means it's adding like economic activity. It's supporting economic activity. It's accommodating the economy, right?
It means you borrow more money, growth.
Right. You could have it where it's in restrictive territory, which means it's really clamping down on economic growth. Or you could have it at neutral, where the Fed funds rate's at a level where it's neither helping nor hurting the economy. So right now, all Fed members will say, even after the cut, that we're still at least a little bit restrictive. But why is there this variance between how restrictive we are? Well, the way you come up with how restrictive the Fed is you take the current Fed funds rate, which after the cut, it's in a range between 4 and 4.25. The effective Fed funds rate is 4 1/8, 4.125. You subtract out the Fed's favorite measure of inflation, core PCE, 2.9%, and then you take out R star. Now, what the heck is R star? Well, without getting too deep into it, this is what you add to this, where it essentially, based on things happening in the economy, gets you to your level of restriction. But it's a level, R star is something that has different interpretations from different people. A lot of people think it's at 0.75, but people like Stephen Marin think it's closer to 0. And that's why even at their 0.75, which a lot of Fed members like the New York Fed president think it is, even with that, you can see the restriction still about 0.5%. So that means that you can still cut 2 more times for 25 basis points to get to neutral, where you're not really juicing the economy. So still have room. And here's an adjustment I did, because some people like Stephen Miran not only think the neutral rate is a lot lower and closer to 0, but they think that inflation should be adjusted because of the temporary impacts of the tariff. So core PCE is 2.9%. But even Fed Chair Powell said he thinks the tariffs are accounting for about 0.4 of that, or maybe 0.3, but let's just say 0.4, which isn't real inflation that the Fed is supposed to look through, because it's going to be short-lived and it's a one-time price increase. Shelter should also be adjusted, because shelter, if you look at real-time readings of blended rents versus what they have in these PCE and CPI reports, they're not even close to reality. And if you were to make an adjustment and put some of the real-time numbers in there, they're lagging behind. They're looking at data over the last 12 months. You'd have a 0.3 adjustment. So if you were to take these adjustments, core PCE wouldn't be 2.9, it would be 2.2. Now, you just make that adjustment, and boy, you could hike, 5 times almost. And if you were to go ahead and do a lower R star closer to 0, like Stephen Moran thinks, you have even more room to cut. So that's why there's, differing views on how much room the Fed has to cut before becoming accommodative. The fear is if all of a sudden you cut and you become accommodative, well, now you can cause inflation again. As long as you're in at least a little bit of restriction, theoretically, at least, you're still clamping down on inflation and economic activity a little bit. So I know that's a little bit technical, but I wanted to just kind of share that with you. But I think the bottom line is I've never seen such an important jobs report that's when it's going to come out on October 3rd, because that's really going to dictate what the Fed does. It's going to dictate where the direction of mortgage rates goes. Boy, if we get a real crap number there, you're going to see the bond market rally. You're going to see much greater odds of Fed rate cuts at both October and December be priced in. And if that happens, you'll likely see mortgage rates like they did before this rate cut. Look forward, price it in, and move lower in advance. Now, what happens after future cuts? I mean, you certainly could see another scenario like we just saw, where you see some really strong economic data that causes things to go the other way. But I think it's an important concept to realize you can't just look at the market movement right after the cut. You got to say, hey, did it move in advance of it and price it in? And was there any economic data that came out that maybe cause the market to be upset.
Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Originator. And what they are doing is they are taking real estate agents and they're taking loan officers, and for the first time in history, they're putting them together under one umbrella. They're actually taking two industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this, you're not just an agent anymore, you're a full-service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com.
One other thing I just wanted to say is that if we compare rates right now to where they were at this time last year, they're actually still higher, even before this recent run up. And the amount of activity we're seeing is much, much higher. New home sales, I mean, we just got a print on new home sales at 800,000. That was the highest level since January of 2022, even though rates last year at this time were lower. And if we look at the mortgage application data from the MBA, refis and purchases, refis making up about 60%, 2 weeks in a row now, we've had some really strong numbers, the highest since 2022. If you look at this area on the chart, this was last year when rates came down to around 6%, but yet you're still seeing a much higher amount of volume of applications, at least for those 2 weeks. Why? Well, I think it really speaks to the pent-up demand. So many consumers didn't take advantage of that back then. And listen, back then, last year, it was only a few week opportunity that you could refi. If you didn't have a mortgage professional you were working with that was really on it, you probably missed it. If you tried to get greedy and save an extra eighth or whatever, you missed it. And the purchase market, it takes longer for that process to happen. With a refi, rates drop, you get solicited, or your relationship for your mortgage professional calls you, yes or no, do you want to refi? You can save money right now. With a purchase, rates drop, then you start the shopping process in most cases. And then what happens? Rates have to stay down through that process in a lot of cases for it to make sense for you to continue through with the purchase. So I'm hoping, and I think it's certainly plausible, that we have a more extended period of attractive rates on a relative basis, and we can see a lot more purchase activity. Certainly recently saw a lot more new home contracts signed in the August report. And boy, that's before we even saw the big decline in September. And this slide shows you household formations. This is one of the best indicators for housing demand. You have a household with a mom, dad, and child, one family living in one home. The child gets older and moves out of the house to either buy or rent. You have the same family, but now you have an additional household. Or a married couple living together in one household. They got separated for whatever reason. One moves out, and now you have an additional household. So it's your demand component. It's been averaging 1.8 million per year. It's a volatile annualized number, but over the last 5 years, well, recently that looks like it's taken a dive, and it's closer to like 1.3 million. So what the heck happened here? It shows you that there's a lot of building pent-up demand, which is why drops in rates, you're seeing a lot more activity happen. But we need to see that happen on a sustained basis.
Yeah, no, I tend to agree with you. I mean, that application curve that you showed represents the minute those rates have dropped, even in that significant little bit of window that we got there, applications went up through the roof in the last 2 weeks. And I think I heard a lot of important things, but two things stuck out to me. That was that take advantage of your window of opportunity. If your mortgage professional contacts you and says, hey, listen, we've gotten to a strike rate, we're in a zone that you want to be at, don't question it. They're not trying to sell you just to sell you. It's because it's an agreement that you guys have had verbally of a rate range you want to be in, and it's there. And to your point, sometimes it's there for a very limited window, and that's not a sales pitch. That's a fact over the last 18 months. We're hoping that window extends a little bit longer if we get a jobs report that's not favorable. And October 3rd, October 4th will be that date for us to look at. But as those reports come out, your mortgage professional may be reaching out to you on the 5th or the afternoon of the 4th going, hey, listen, we're there again. I'm not pulling your leg. Like, this is it. It could be here. And if we get any other future, positive information, it could evaporate again. So take advantage of that opportunity. And waiting on an eighth could cost you thousands of dollars and years of repayment just for waiting to get that better eighth number. And again, for my mortgage professionals that are listening to this, if you're not using MBS Highway, you're not taking advantage of those calculators they have, which are just endless tools we use all the time. They're wonderful, and they're constantly evolving and improving over there. It's awesome. There's just great things to use over there to really share this with the person instead of trying to just speak it to them. You can share it to them in a link to where they can see all the data and see exactly what you're referring to.
Quinn, this is a pretty good illustration, I think, of, marrying the home, date the rate over the last few years has been a good strategy, but you need to have had a mortgage professional that was really watching this and on it, because these highlighted yellow areas, these were all refinance opportunities, but you could see in some of them,
on the board there,
a day, right? A day,
yeah.
A week, a couple days, a week, right? So, and by the way, rates pretty similar in some of these scenarios because the mortgage spread, or the spread between 30-year fixed rate mortgages and the 10-year, has narrowed, which is a good thing for us for mortgage rates. But you can see the fleeting nature a lot of times of the opportunity. So as you said smartly, Quinton, if you have the opportunity, if you could save a few $100 a month, that's real. If you're waiting for a little bit of an improvement, it may not be there for you.
Yeah, no, it's exactly right. And for our audience, Dan, first take, you think the job number is going to come in? I mean, obviously you don't have a crystal ball. If you did, it'd be a whole different situation, but you have a gut feeling that they're going to come in.
Here's what I think. So if we look back to 2024, right? Mm-hmm. And you can't, this is a very short time period, a week or so after the Fed cut. So it's certainly way too early to see what's going to happen with rates going forward here, right? But if we looked at 2024, I showed you the chart before where the markets moved down in anticipation, and then they were stable after the 50 basis point cut on September 18th. But then we got that monster 254,000 job creation report October 4th for the month of September. And that really started sending rates higher. And then we got another one November, another one December. So I don't think that we're going to see that happen this time around. If we were to look at the last few jobs reports, they were very, very weak. So I definitely think something's changed there. And, we know that the BLS has been reporting numbers and then revising them lower, but the initial reported number for September was 22,000. So let's see what happens with that figure. Maybe they revise it higher. Who knows? But we know that they've had issues. Some of it's response rate. Some of it's that they're using more imputed data than ever. But I don't see anything out there that is showing me that there's this pop of hiring. I still think it should be a weak report where we see weak job creations. So that means that when we get the September jobs report on October 3rd, I think we're going to see a weak level of jobs created. That's one part. There's the revisions, which is another part. And then the unemployment rate, which most people don't realize, it actually comes from a separate data set within the jobs report called the household survey. So it has its own job creation number, not the same as the headline figure. And then it has the labor force, right? And the number of unemployed people. So the unemployment rate is a ratio. The number of unemployed people divided by the labor force. The labor force, the number of unemployed people has been going up, but the labor force has been affected by immigration. So, if all of a sudden we, start to see some changes there, you could see more unemployed people, but you could still see the unemployment rate remain stable. Now, something that's interesting, so I don't know if the unemployment rate is going to go up from 4.3, the current level. In the previous report, it was 4.2. It went up to 4.3. I don't know if we're going to see that go up to 4.4 or not. My forecast for the end of the year is around 4.5, but I do think that it's something we have to watch closely. And Austin Goolsbee, the Chicago Fed president, something that I like that I'm seeing is a couple Fed members, Bowman, Goolsbee, starting to talk about how the Fed's data dependent, but that means that you're always going to be behind the curve because the data is backward looking, right? So we need something that's more real time so we can really look forward, almost like looking through the forward front windshield of the car instead of the Fed always looking through the rear view mirror and out the back. So the Chicago Fed came up with a new indicator, brand new, another data point for us that we like, Quinton, that we could take a look at. It's called churn, which is the Chicago Fed unemployment rate nowcast. So essentially, it's not like published on a site yet, but they've released some samples of it. And he got on CNBC and spoke about his expectations for the jobs report. And what they do, which sounds pretty interesting, we're going to be able to benchmark their report pretty soon and see how they did, right? But instead of just looking at the BLS data, they're also looking at ADP, which is actual payroll. So, that's pretty good data to look at as well. The BLS is a lot of modeling, birth-death ratio, a lot of things that skew stuff, right? And then they're also looking at data from Indeed, job posting sites, and even things like Google Trends. How many people are searching for unemployed or searching for jobs and things like that, right? So they're taking a more holistic, real-time approach, and every week they're going to release estimates. But their estimate for the September jobs report, which will be released again October 3rd, is that the unemployment rate remains stable at 4.3%. Let's just say they're right. That's okay. But if we get a really weak job creation number, that'll be good, and that will help things. And I believe we'll see a nice rally in the bond market. And I also think that we'll see higher expectations for further rate cuts this year. Now, boy, if the unemployment rate went up, forget it. It'd be a party. But I don't think we need to see that. Now, on the flip side, if for whatever reason we see some higher revisions to the previous months, we see a stronger than expected job number, the unemployment rate declines, we're in trouble. You could potentially kiss future rate cuts this year goodbye, and you will likely see the bond market sell off in a bad way.
Yeah, that'd be a bad thing. Bad thing in the sense of that's not what we're looking for here. That's something I wanted to add to that dot plot, Matt. They don't release that every meeting. It's on every other meeting, and traditionally speaking, is it
not accurate?
There you go. Okay, I was going to say I thought I read 76% of the time.
Not accurate at all.
Okay,
not accurate at all.
So I guess where I'm going with that is their opinions change every 60 days, and you could see that fluctuate quite a bit over the next 60 days. If this job report comes in a very unfavorable manner, we could see a lot more of that divide become more in sync with one another, and that would be a win for all of us.
For sure. Yeah, no, I mean, those things, they bounce around like you wouldn't believe. I mean, there were years where before the year, they said that they were going to, hike once and they hiked like, it's never accurate, the dot plot chart. But, it's because they are data dependent. And as the data comes out, they change, their minds. But it's more accurate the closer you're looking, right? Yep. So like and the Fed futures are very accurate the closer you're looking to. So, if we're getting like a couple of weeks here before, like a week or 2 weeks before the October meeting, when we get there, usually what you see priced in is what's going to happen.
Yep. Yeah. Well, the countdown is on to October 3rd, October 4th. All eyes are on that report. And if you got anything from this podcast, I think it's the following things. Number one, that's going to be the date that changes a lot of the Fed's mindset and decision making. And then don't wait on it. Like if the rate's there and you've got an opportunity to take advantage of that with your mortgage special, do it.
And I got one more thing, Quinton. Do you guys have a good ARM product?
We do. Yeah.
You do. Okay. So one thing, especially for the consumers, because I know the mortgage professionals listening know this, but for the consumers out there, a lot of people, they hear about adjustable rate mortgages and they're like, whoa, I'm not going near that thing, right? But let's just use a 7-year ARM, for example. The rate is fixed for 7 years. And then there's some adjustments that occur. Now, even in the most draconian scenario, because of the savings you're going to have in a lot of cases with the 7-year ARM, like for instance, I'll give you my example. I just refinanced my property in Florida, and I got like a 5 3/4 rate on an adjustable rate mortgage, certainly much lower than I could have gotten on a 30-year fixed. It's fixed for 7 years, but then there's certain caps and lifetime caps on the adjustable rate mortgage, so it can't just go up into eternity. But it has to be mathematically better than the 30-year fix based on the savings that I'm having for 9.5 to 10 years. So, and that's if rates just skyrocket. Okay. So when's the last time, ask yourself, that you've been in the same home with the same mortgage for more than 9 years? And if we look statistically, it's single digit percentages of people. Right. I did this personally for myself because it was the best rate I could get. And I know over the next 7 years, 8 years, 9 years, I'm going to have an opportunity to refinance to a lower rate. Markets are cyclical. this isn't going to go on forever, right? We're
Right.
seeing the stock markets at all-time high after all-time high. The wealth effect is a real thing. I think over that period of time, it's safe to say we're probably going to see a recession. During recessions, interest rates always decline and decline significantly. So that's not an option it's not like, it's not necessarily the choice maybe for everybody, but it's something you should consider and ask your mortgage professional about. What are your thoughts on that, Quinn?
No, I agree. I mean, there's going to be certain states that refinances are more expensive than others, but even in that scenario, I mean, if you can lock in a rate and you have those protective caps, as you mentioned there, you can't lose on that. I think the downside of an ARM, and the only downside of an ARM, is that not everybody can offer those ARMs because for various reasons. Number one, there's limited margin available in them. Some lenders don't partake in them. Some programs like FHA, you're not going to get what you're describing because they don't have that type of ARM feature. They do have one, but not in that length. So depending on what loan you qualify for, in that conventional jumbo margin, there's a great opportunity to do those 7-year ARMs. And, I also think a 5-year is not bad as well either in this market. If you can do the 5, you're going to get a little bit of a cheaper rate. But again, in 5 years, markets are going to cycle. You're going to have an opportunity to take advantage of that. And all those loans come with no prepayment. So you can do it. It's a great win there if you can take advantage of it. So yeah, that's a great opportunity. So Dan, as always, man, thanks for being on the show, dropping complete great industry knowledge on everybody. But more importantly, customers, real estate agents, I can't say this enough. I know I sound like a broken record here, but the rates are in a window. They're an opportunity. Take advantage of them, lock them in, whether it's a refi, get your pre-approval, get your contract and lock these loans in, because I guess I'm living on the edge here that these windows of opportunities, they're getting shorter and shorter because we don't get them longer than maybe 48 to 72 hours right now. And this is no sales pitch. This is a reality. And we talk about it all the time. The window of opportunities there, take advantage of it. Don't miss out.
Well, Quinton, thanks for having me, brother. It's always a pleasure.
Absolutely. Guys, if you like what you're hearing, please subscribe to our podcast on YouTube. Check us out on Apple and on Spotify. Leave us a review. Leave us a ranking there of 5 stars. Greatly would appreciate that. And guys, till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do